Welcome back to the deep dive. We're here to cut through all that noise and get straight to the useful insights.
Yeah, because the world of personal finance investing, it can feel like an overgrown jungle sometimes, can it?
Exactly. You're looking for clear, actionable wisdom, not just, more data dumped on you. And that's really our mission today. We've pulled together a stack of really fantastic sources for this deep dive.
We have.
Everything from essential personal finance books aimed at beginners to some great articles debunking common money myths.
And that fascinating look into global investing too.
Right, with a specific angle for Indian investors, but honestly, the lessons apply pretty much everywhere.
Absolutely. The goal here is to hand you those truly insightful takeaways.
Those aha moments.
Exactly. The moments that empower you, help you understand not just what to do with your money, but why it's maybe the smartest move for your future.
We want to be your guides through this material, sort of extracting the core nuggets.
Connecting the dots, maybe challenging some ingrained beliefs along the way.
And encourage you to think critically about your own financial journey. Turn that complex info into clear, confident action.
So where should we start?
Let's jump right in, maybe tackling some fundamental beliefs about money. Things that, often turn out to be misconceptions.
Sounds good. Like those fidelity money myths debunked. They highlight how easily we can fall for misinformation.
Yeah, and one really pervasive myth, a huge barrier for so many people is, it's not worth saving if I can only contribute a small amount.
Oh, that one. And what's truly insightful, looking at the sources, is that this myth is just. It couldn't be further from the truth.
Really?
Yeah. In fact, even very small, consistent savings, especially if you start early, they don't just add up. They can genuinely lead to significant wealth over time.
So it's not just like putting pennies in a jar.
Not at all. It's about harnessing the incredible, often really underestimated, power of compound interest.
Compound interest. Okay, the famous one. We often hear it linked to Einstein, right? He who understands it earns it.
He who doesn't pays it. Yeah, it gets called the eighth wonder of the world.
But beyond the catchy quotes, what does it actually mean? For someone trying to build wealth, especially if they feel their contributions are small, what's the practical magic?
The practical magic, you see, it's that compound interest means you're earning interest not just on your initial money, your principal, but also on the interest that's already piled up from previous periods.
So interest on interest.
Exactly. Think of it like a snowball rolling down a hill, as one source puts it quite vividly.
Right.
It starts small, maybe just a little bit of snow, but as it rolls, it picks up more snow. And it grows faster and faster exponentially as it gets bigger.
So the key isn't how big it starts.
Not necessarily. It's more about the length of the hill, the time, and how consistently it keeps rolling. So even if you start with, say, just 1,000 in an SP in India, or maybe $100 elsewhere, over decades, that growth, building on growth, it accelerates dramatically. And this isn't new. Historically, it was called anatocism. There were tables for it back in 1340.
Wow, okay, that's a powerful visual. Small, consistent actions today leading to, exponential results tomorrow. That's motivating.
It really is.
Which brings us neatly to another myth, one that often costs younger investors quite dearly.
Well, let me guess. I'm young, I don't need to save for retirement yet.
That's the one. It feels like the flip side of that compound interest coin, doesn't it?
It absolutely does. Because time isn't just an ingredient for compounding. It's really the most critical, irreplaceable one.
Can't get it back once it's gone.
Precisely. Our sources really emphasize this. If you start saving at, say, age 25, consistently putting aside maybe 15% of your paycheck.
15%.
And that includes any employer match you get for your retirement plan, whether it's a 401k or maybe MPS or EPF here in India. You're setting yourself up to likely maintain your current lifestyle when you retire.
But if you wait...
that's the kicker. Delaying even 5 or 10 years. It means you'll have to save significantly more later just to catch up. You miss all that early compounding time.
And that employer match.
Oh, absolutely critical.
Right.
Always take advantage of employer matches. It's essentially free money just sitting there if you don't contribute enough to get it. Don't leave it on the table.
So time is our greatest ally here. But how do we know if we're, actually on track? The big question for many is, how much money will I really need for retirement?
That's a common one and a really good question.
Do our sources, like Fidelity perhaps, offer any benchmarks or guidelines?
They do. Fidelity, among others, provides some helpful guidelines. Think of them as financial signposts along the way.
Okay.
They suggest aiming to save at least 1 times your income by age 30.
1 time by 30?
Then 3 times by 40, 7 times by 55, and aiming for about 10 times your income by age 67.
10 times by 67.
Wow. Now look, these aren't rigid, hard and fast rules for everyone. Circumstances differ, but they are incredibly useful benchmarks. They help you gauge your progress, see if you need to maybe adjust your savings rate. The key is starting to track it early and being proactive.
Right, being proactive. Which leads us right into another common worry, maybe a barrier for some, the belief that the stock market is too risky for my retirement money.
Ah, yes. You see this a lot. People preferring traditional savings accounts, fixed deposits, especially maybe here in India.
They feel safer, I guess.
They do offer that sense of security, that safety. But what's the deeper implication? What's the trade-off?
Well,
The low interest rates on those savings accounts, FDs, they mean your money barely grows. And often, it actually loses purchasing power over time because of inflation.
so you feel safe, but you're slowly getting poorer in real terms.
Exactly. The stock market, on the other hand, yes, it has ups and downs, volatility, but it has a remarkably consistent, long history of growth, historically beating inflation by a significant margin.
So for long-term goals, like
Okay.
retirement.
For those long-term goals, diversifying into equities, both domestic and, as we'll discuss, global isn't just, a good idea. It's almost essential to make sure your money keeps working for you, maintaining its value over decades.
So it's not about avoiding risk completely, but understanding it, managing it for the long haul.
Precisely.
And this is where maybe simplicity wins over complexity. We aren't talking about becoming like expert day traders here.
Absolutely not. Think about John Bogle's Common Sense on Mutual Funds or Ben Carlson's A Wealth of Common Sense. They both champion this idea. Low-cost, broadly diversified portfolios.
Keep it simple.
Exactly. For beginners, or anyone short on time, options like managed accounts or target date funds. They offer professionally diversified strategies. They basically simplify the whole process.
Kind of puts diversification and long-term growth on autopilot.
That's a great way to put it. And it aligns perfectly with harnessing that compounding power we talked about earlier.
Okay, that makes sense. So we've talked about growing money, starting early, but financial health isn't just about assets, right? It's also managing liabilities.
Crucial point.
So let's pivot now to the often debated topic of debt and credit cards. Is all debt bad? Should we just avoid credit cards altogether?
Another area just filled with myths. And painting all debt with the same brush, it's really a disservice to your financial strategy.
How so?
Well, sure, high interest debt like credit card balances you carry over month after month. That can absolutely be a financial trap. It costs you so much more than you originally borrowed.
Right, the interest is killer.
But then there's good debt. Think mortgages for a home, maybe student loans for education.
Okay.
These can be powerful tools. They help you achieve really significant life goals, often come with much lower interest rates. And in many places, like India with home loans, parts of it can even be tax deductible. This kind of debt is more like an investment in your future.
An investment, not just a burden. That's a key distinction. And credit cards. Used responsibly, they aren't just a path to ruin, they offer actual benefits.
Absolutely not if you leverage them smartly. The key is paying off that balance in full, every single month.
Avoid the interest charges?
Right. Then you avoid interest completely, and you get to unlock all those rewards, cash back, travel points, whatever your card offers.
That's the tangible benefit.
But maybe even more important, responsible credit card use is one of the fastest ways to build a strong credit score.
The credit score.
And a good credit score. That can lead to much lower interest rates on future big loans, cars, homes, saving you potentially huge amounts of money down the line. It's about using the tools intelligently, not just avoiding them out of fear.
Using them intelligently.
Yeah.
That idea of smart decision-making, understanding the nuances, it really brings us to that fascinating area of behavioral finance.
Yes.
It seems our emotions, our biases, they play a much bigger role in how we handle money than we often realize. It's not just spreadsheets and numbers, is it?
Oh, profoundly not. What's truly fascinating here, and our sources really dig into this, is that financial decisions aren't made in a vacuum.
Right.
They're deeply influenced by our personal history, our ego, pride, even clever marketing tactics.
So can you give an example?
Sure. Books like Morgan Housel's The Psychology of Money explore these strange ways people think about money. like loss aversion.
Loss aversion.
Yeah, the idea that the pain of losing, say, $100 feels much stronger, much more intense than the pleasure of gaining $100.
I can see that.
And this bias, it often makes people hold on to losing investments way too long, hoping they'll recover, or maybe shy away from the stock market entirely because they fear the potential loss too much.
Interesting.
And then you have Richard Thaler's work in Misbehaving and Nudge Baiting. He shows how understanding these inherent human biases can help us gently nudge ourselves towards better decisions.
Without restricting our choices.
Exactly. Without forcing anything. It's more about being aware of your own mental shortcuts, your own biases, and then maybe building systems or structures to counteract them.
That self-awareness seems key. And understanding that behavior is crucial, especially maybe as we think about expanding our financial horizons, looking beyond our local borders.
Absolutely.
Because for many people, particularly Indian investors, as their sources highlight, there's a pretty significant home bias in investing.
Yes, that tendency to just invest primarily or even exclusively within your own country.
Even when there are global opportunities out there, what's the hidden cost of doing that?
Well, if we connect this to the bigger picture, the hidden cost is potentially significant opportunity and crucially diversification.
How so?
Consider this.
Yeah.
India makes up only about, 4 to 5% of the world's GDP?
Okay, a small slice globally.
Which means roughly 95% of global investment opportunities, the vast majority, lie outside India's borders.
Wow, 95%.
So diversifying into global markets, maybe starting with, say, 20-25% of your portfolio. It isn't just about chasing potentially higher returns somewhere else.
It's about risk, too.
It's a powerful way to reduce risk. You're hedging against purely domestic economic issues, tapping into different economic cycles, different growth themes that might not even be available here.
So not putting all your eggs in one geographic basket.
Exactly that, but on a global scale.
Okay, so what does this all mean for you, the listener, if you're thinking, all right, maybe I should explore global investing, move beyond this home bias? Where do you even start? It sounds complex.
It can seem that way, but there are some pretty straightforward starting points. The U.S. markets, particularly through something like the S&P 500 index.
The S&P 500, heard of it?
Right. It's often recommended as an excellent, robust starting point for global diversification.
Why the U.S. specifically?
Well, U.S. markets represent more than half the world's total market capitalization. And the S&P 500 includes huge global companies whose products we use every single day. Think Google, Apple, Meta, Facebook.
So they're not just U.S. companies.
Exactly. They're global giants.
Yeah.
And interestingly, for Indian investors, the S&P 500 has actually outperformed Indian markets in U.S. dollar terms over the last 15 years or so.
And you get that potential currency benefit, too, if the rupee depreciates.
Precisely. It's a way to own a piece of the world's leading innovators quite easily.
Okay, so broad exposure, like the S&P 500 is one way. But our sources also mention more nuanced strategies, like tactical allocation, even contrarian investing. What does that mean globally?
Right. Think of Benjamin Graham's famous idea of Mr. Market.
Mr. Market?
Yeah, this imaginary guy who shows up every day offering to buy or sell investments, but his prices are often based on his mood, sometimes euphoric, sometimes depressed.
Okay.
So when Mr. Market's mood is, let's say, not very good about a certain region, and prices there get really beaten down, maybe like China experienced starting around 2021 due to various factors.
Right, I remember that.
That's when contrarian opportunities might pop up, because markets often have this tendency to revert to the mean over time. What goes down might come back up.
So buying when others are fearful.
Essentially, yes. The sources point to Japan's strong performance in 2023-24 after, a really long period of poor returns. It illustrates that patience often, maybe 1 to 3 years can be key when you make these kinds of tactical contrarian bets. You have to understand that cycles happen globally.
Interesting. But how can individuals, especially our listeners in India, actually access these global markets? Does it mean opening complicated international bank accounts? Dealing with lots of red tape?
Thankfully, it's becoming much, much more accessible now. Probably the simplest way for most people is through mutual funds.
Okay, mutual funds, I know.
Specifically, look for what are called feeder funds. These are basically Indian mutual funds that invest directly into a larger, established international fund.
So the Indian fund manager handles everything.
Exactly. They handle the global allocation, the currency conversions, all the regulatory stuff. It makes it very straightforward for the investor.
That sounds manageable. Are there other ways?
Yes. For high net worth individuals, there's India's LRS, the Liberalized Remittance Scheme, that lets you directly send money abroad, up to $250,000 per person per year to buy shares directly.
Okay, for larger investors.
And there's a newer growing route, Gift City. That's India's International Financial Services Center. It allows Indian fund houses to launch global products without facing certain industry-wide limits.
So more global fund options becoming available.
Essentially, yes. It expands the menu of feeder funds and other global products, though your individual LRS limit still applies if you're remitting funds directly through Gift City structures.
Yeah.
But overall, these options really demystify global investing for local investors.
That's good news. Well, what about taxes? For Indian investors, taxing global investments often feels like a big hurdle, another layer of complexity.
Yeah.
Has anything changed there?
Yes. And this is really significant news. A recent Indian budget change has simplified things quite dramatically.
How so?
Basically, global fund and stock investments, if you hold them for over 2 years, they're now taxed at 12.5%, plus the relevant surcharge and cess.
Okay, 12.5% after 2 years. How does that compare?
It makes it largely comparable to the long-term capital gains tax on Indian equities, which is 10% after 1 year, for gains above 1 lakh.
So that historical disadvantage, that tax barrier.
It's largely removed. It makes global investing a much more attractive option from a tax perspective now, aligning it much more closely with investing domestically. It really levels the playing field.
Wow, okay, genuinely sounds like there's a world of opportunity, quite literally, just beyond our local markets and maybe traditional savings methods.
It really is about thinking bigger.
Yeah, recognizing that maybe some future-focused themes, things like semiconductors, AI, genomics.
Right. Often, the large-scale listed investment opportunities in those cutting-edge sectors aren't readily available in scale within India yet.
So global investing opens that up.
It expands your portfolio to potentially include these best-in-class companies worldwide. It offers that diversification we talked about, access to different economic cycles, and a stake in the industries that are really shaping tomorrow.
We've covered a lot today. We've taken a deep dive into making sense of your money, really. From understanding that true exponential power of starting small with compound interest.
And busting some common financial myths.
Right. And opening up that vast potential of global investing for everyone, but especially for our listeners here in India.
And exploring how our own psychology, our financial behavior, can be just as crucial as the numbers themselves.
We've definitely seen that managing your money isn't just about formulas or spreadsheets.
No, it's so much about behavior, about perspective, and importantly, about patience.
The path to financial well-being, it seems like a continuous journey, doesn't it? Learning, adapting.
Making informed choices based on sound principles, not just, gut feelings or market noise.
So after all this, what does it all mean for you listening right now?
Yeah, what's the takeaway?
Well, if, as we heard earlier, he who understands compound interest earns it, he who doesn't pays it. What's one single small step you could take, maybe even today, to embrace some of this knowledge?
To put it into action.
Yeah, to move just a little bit closer to your own financial goals. Will you maybe reevaluate how you use your credit card? Or finally start that small, consistent SIP you've been thinking about?
Or perhaps take that first step towards looking at global diversification for your portfolio.
Maybe explore some of the books we mentioned, like Morgan Housel's The Psychology of Money to understand your own biases better.
Or P.V. Subramaniam's Retire Rich. Invest RS40 a day for really practical, actionable steps.
The point is to start building that financial literacy one smart decision at a time.
Keep learning, keep adapting.
Exactly. Until next time, keep digging deeper.